Seema, you're seeing the European trade play out. It's a deterioration. U.S. futures seem to be deteriorating again. So does this mean that we're not out of the woods with regard to yesterday's sell-off?
No, absolutely not. I think that what's really interesting is, you tend to see, if you see a very sharp drop like you saw yesterday, that it would tend to have a rebound the next day with then a slow retrenchment downwards over the following days. The fact that this doesn't look like it's coming through suggests that investors are really reluctant to buy the dip, and there is still a huge amount of caution in the market.
Why are they reluctant to buy the dip? Only because over the past 11 years, it's been a total winning strategy. These recoveries have been V-shaped every time there is any kind of a pullback. Why is this time different?
Well, look, I think it's now moved beyond comparisons to SARS. We are in a position where China is a much larger component of the global economy. Supply chains are considerably more complex. So it does mean that this epidemic is having a significantly greater impact on global growth. Now, on top of that, the news over the weekend was very concerning with regards to the rest of the world. So whereas many markets had peaked last week, or at least they'd hit new record highs, it did seem as if there was a view that at least the peak in the virus had been met. Now, with this news over the weekend, it suggests that actually the situation may be worsening and that global growth forecasts need to be downgraded somewhat.
Okay, so we just showed a graphic, and for listeners on Sirius XM channel 112, what you didn't see was there are 3 stages that you've laid out with regard to how you see this going. Take us through those stages and why that may be indicative of why we're not seeing a bigger bounce so far this morning.
Absolutely. So, you have the 3 stages. The first stage is what we were expecting, what I think what most of the world was expecting a few weeks ago, where it's largely contained into China. And you do have activity restarting by the end of March. So supply chains are slightly damaged, but at least not permanently hurt. The second stage is what has been creeping into market fear over the last few weeks, which is that actually supply chains take longer to get restarted and you get more of a U-shaped recovery. The news over the weekend really takes you to stage 3, where real fear is that maybe the rest of the world is just where China was at the end of December, which is the beginnings of a new epidemic. Now, of course, these market fears are very much exaggerated at this stage. There's a huge amount of uncertainty, but this is really why you saw that very sharp drop yesterday.
Is this a scenario right now, given those 3 stages that you laid out and heading towards stage 3 possibly in your scenario, would you be looking to, from a strategy standpoint, put protection on, and exactly how would you do that?
I think at this stage, it makes sense for investors to have real caution with regards to their portfolio. Given that there is so much uncertainty, it may not be the time to start reducing your exposure to risk assets, but potentially the best thing to do is start increasing exposure to your typical safe havens. So that's a US dollar, US treasuries, and precious metals. And of course, other high quality fixed income assets. So those are probably your best places to place your assets if you want a little bit of protection.
It doesn't bother you, Seema, at all that we are looking at 30-year long bonds in the U.S. Treasury market at record lows and then near record lows for 10-year U.S. Treasury notes? It seems so expensive to go to some of those safe havens. You're paying up for that insurance.
No, absolutely. That goes with that question. It is extremely expensive. The thing is that, look, the market is very vulnerable to any kind of negative news flow at this stage. Now, over the next 2 weeks, market's going to be waiting to see how this pans out with that time with the quarantine. So I think what we're expecting to see is that negative news flow could continue to push down some of those US Treasury yields. So actually, this may be the safest place to be at this stage.